All right, example 3, Medicare enrollment, coverage gaps and late penalties. If you're not aware of it, you're going to be aware of it from my presentation here. You have a time frame that you must sign up for Medicare. If you do not sign up for in that proper time frame, in other words, on time, you get to pay a penalty, and the penalty lasts the rest of your life. Let me say that again. If you don't sign up for Medicare on time, you get assessed a penalty. And that penalty is not for just 1 month or 1 year. It is for the rest of your life. You want to make sure you sign up on time. And this is one of the greatest reasons that I mentioned earlier that I do a Medicare presentation for folks, because it is that critical. So let's just look at this example. Jim and Ann. Jim retired at age 65, and Ann retired 1 year later. So at 65, Jim didn't sign up for Medicare. He went on to Ann's coverage because economically, perhaps that was better. They got coverage through Ann's employer, who offers retiree health insurance. So it was a better economic deal. That's probably why Jim did it. Then when Ann retires, okay, they have to sign up for Medicare. They both do. You can't get Medicare coverage instantly. Okay, there are sign-up periods. And the missed enrollment period, this is the penalty, it's 10% of the base premium for life. So let me just do a quick calculation. If, let's just say you're late this year. Let's say this is the year you're late. Well, for 2022, it's 10% of the premium for Part B, which is $170.10. So that's $17.01 times the 12 months is $204, times 2 people, which is $408 for the couple forever. Now premiums go up. So when the 170 next year go up to 180, well, now it's $18 times 12 times 2. You follow me? So you want to make sure you're not late, because this is another tax that you're basically going to pay if you're late in signing up. Just this error here could add up to over $10,000 as an issue for folks. Wow. So are there other tax traps we face in retirement? Well, let's go on. I just want to make sure people are aware of this. You must plan how and when to use taxable, tax-deferred, and tax-free assets to manage your income tax brackets efficiently. Now, I have to tell you, this is more complicated than even my statement indicates. You basically have 3 kinds of money. You have taxable money. Think of monies in a brokerage account. You have tax-deferred money. Think of monies in an IRA or a 401k. And then you have tax-free money. That's a Roth. Think about that. Those are the 3 different types of money you have. So when do you spend which when? Yeah, when do you spend which when? Say that 10 times fast. But this becomes an issue. And I'll tell you something. If you have a situation, and this is very common, there's no uniqueness here. You have a couple here, let's just call them Sam and Mary, and they have $8,500 they want to spend per month. Well, Mary has an IRA, Sam has an IRA. Mary has a Roth, Sam has a Roth. Then they have a joint bank account together. All right, what do we do? Well, the traditional way, in ways that people had conventional wisdom, if you will, spend the taxable money first, so the bank accounts, then spend the tax-deferred money, the IRAs, and then spend the tax-exempt money. Well, there's been a whole lot of analysis done on that with a bunch of guys that have PhDs after their name. These aren't advisors. They're not CPAs. These are guys that, professors. They're financial professors. They teach finance and accounting type stuff. They did some analysis on that. And let me tell you, there's a new conventional wisdom. The alternative approach says you spend the taxable money first, but also convert IRAs to Roths in low tax years, then spend tax-deferred money until depletion, then spend tax-exempt money. So this alternative approach, as opposed to the first approach I shared, would add 2 to 3 years onto the length of time that your money lasted. And that's stuff that these guys have worked on. If you want some of those books, I could get them give you the reference to them. But I think 2 or 3 years, if you can expand or extend your portfolio, I think that's significant. I think that's really good. Okay, consider Roth IRA conversions. So again, IRA or similar are moved to a Roth IRA. Taxable amount converted is added to your income. So a very simple example. In fact, I just had a client who just did a $100,000 Roth conversion. What does that mean? Well, the $100,000 goes from a traditional IRA into a Roth IRA. So 100 to 100. But when you do that, that causes a taxable event. So that $100,000 is like you got a $100,000 bonus. You owe tax on that money. How much? Well, it depends on what marginal tax bracket you're in. If you're in the 22% bracket, you might owe, on that $100,000, $22,000 of taxes. You could owe $37,000 of taxes. So, but that's something that you might consider doing in low tax years. I think that's an excellent strategy. I love this approach. I do this quite often with my clients. It's called filling the bucket. So let's just say we're in the 22% tax bracket. And mind you, on a joint filer in the 22% tax bracket, that basically means that you can get up to $89,000. In the 24% bracket, it's $170,000. But let's stick with the 22% bracket. You see here, the water line is half full. So maybe we have $45,000 of taxable income as a joint filer. Well, if that be the case, you can get up to 89,000. So you can actually do about, 89 minus 45. You could do about $44,000 of Roth conversions, and you'd stay within the 22% bracket. That's the concept, okay? Fill the bucket and don't go and try not to go over into the next bucket. But that's the idea. And then once you have that bucket filled, just remember, whatever you add in there and put it into your Roth, that's a taxable event. So you'll have to pay tax on that money. But now the beautiful thing is that Roth then grows tax deferred and the dollars come out tax free. So it really is a very, very powerful step, especially if your view of the world is you see taxes rising in the future. And if that be the case, quite frankly, would you rather pay tax on the seed, or would you rather pay tax on the harvest? I'd rather pay tax when the accounts are of lower value, so the tax is not as great. So that's the good deal there. Low income are good years to do Roth conversions. So many times people retire at age 65, 66, 67, but they have not turned on Social Security. And the RMDs, which start at 72, have not begun. So they have very low tax years. Those would be excellent times to maybe convert some money to a Roth. And I would caution you, please consult with a tax advisor. I do a lot of this tax planning, but I never pull the trigger on a Roth conversion without bridging in the CPA that the client uses and running it past them. So just, caution there. But some common examples of what would be good. Business owners with unusually low sales, business unusually high expenses. And incidentally, this is a team sport. I had a business owner, HVAC business owner. He did heating, ventilation, and air conditioning, small business. Unbeknownst to me, he had an $86,000 carry forward loss, and he was looking to convert like $100,000 Roth conversion. And I thought it was too much. So I said, let's bridge on your accountant. And we bridge on the accountant, and the accountant says, oh, I think that's a good idea. He has an $86,000 carry forward loss for something. I whatever happened. But the accountant said, yeah, this would be a good year to do a big Roth conversion. So, again, I didn't know that. The accountant knew that. My client wasn't sure of it. And there you go. That's why this is a team sport, and you really have to work with other professionals on it. High non-recurring medical bills after retirement. This is what I just spoke about. After retirement, before receiving your Social Security benefits, pensions, or IRA distributions. So if you're in that category, I would recommend go see somebody, see myself, but get some ideas on what your planning could be so that you could save taxes down the road. So, and always keep in mind, by the way, I put this chart in very recently. What's the goal? What are you trying to achieve? You have to know whether you're trying to keep income below a certain bracket or threshold to avoid bumping into the next one, or whether you're trying to increase income to fill up the bracket to take advantage of the tax rate. So just know what your goal, what you're trying to achieve is. Other approaches to managing taxes, withdrawing tax-free money from a life policy. Now that's interesting because in the example that I opened up with, the teaser, if he had taken $1,000 from the cash value of a life policy, that's considered debt. That's not considered income. That would not have triggered all the taxes he had to pay if he indeed got the money from there. Selling highly appreciated stock for low and no capital gains. You can do that when you have no income. If you have zero income, you can basically sell highly appreciated stock and pay no tax on it. But again, you want to approach your CPA and just get his or her counsel on that. And you may purposely take distributions from IRAs because you're going to pay very little money in tax on those distributions. Because yes, they're income taxable, but you have no income. So if you're taking from the IRAs or the 401s when you have no income, you're going to pay lower tax to get your money out of there. So that sharing you do with that uncle of ours is certainly not as great. And I think that's a good maneuver. Two other pre-retirement strategies. I'm a big proponent of health savings accounts, HSA. So if you have a high deductible health plan and you have the ability to participate in an HSA, please do so. They are powerful. You can put the money in. It's a tax deduction. It grows tax-free and it comes out. It grows tax-deferred and it comes out tax-free. Really good stuff. And then don't forget about, if you're a small business, you have the qualified business income deduction, QBI. Just remember you have that as well.